Hello Sector Watchers, welcome to the show. This is the 69th episode of Sector Spotlight for Tuesday the 2nd of March. I'm recording it on Monday the 1st of March. If you would like to stay in touch, ask any questions, have any recommendations, have anything to say, please use any of the handles on the screen. You know I love the interaction. And you will, most of the time, 99% I'd say, get an answer from me personally. For now, we have a full show because it is the first Tuesday of the month. We will go over the monthly charts for the various asset classes and sectors. We'll also look at what happened last week, see if we can find anything meaningful there. Possible, try to put that into a longer term perspective with the weekly charts, but that might get a little bit fuzzy and busy because we got the short term and then we got the weekly and we're looking at the monthly, so we'll see how that goes. And then I want to share with you something that I found out last week, and that is actually using a family of ETFs representing small cap stocks. So we can actually do an RRG showing sector rotation among small cap stocks, and I think that's very interesting. So I'm trying to tell you a little bit more about that. But for now, let's get a start with a look back at what happened last week. Let's start as usual with the RRG for asset classes. If we look at the table below, then we see the 5-day performance, or last week's performance. For the benchmark, it was down 1.8%, and leading on the downside, stock market minus 2.8%, and leading on the upside, again, commodities and the US dollar, but commodities up 1.4 for GSG and up 0.3 for DJP. So they're pretty much continuing their positive stint. With stocks down, we will see obviously the fixed income asset classes, GOV, LQD, HYG, high yield, floating atop, so outperforming the benchmark. And we have real estate down 1.2, but it's outperforming the benchmark. If we look at the tails, then we obviously see the two commodity indexes moving nicely into the leading quadrant. We also see the rotation for ITOT rolling over downward and entering the weakening quadrant, while the fixed income related asset classes are moving upward and have entered the improving quadrant. Now, this is the short-term picture, and let me put that immediately into the longer term perspective, and then we have the weekly RRG right here. And you can see that stocks ITOT are still positioned well and way to the right of GOV. So the long-term picture is still pretty much in favor of ITOT, but we do see, I'd say, a tactical or maybe temporary, or at least for the time being, temporary move in favor of GOV over ITOT going on. Not massive yet, but it's something that we need to be aware of. Especially the fact that the tail on ITOT is very short. It's one of the shortest on the canvas, together with HYG and LQD, but it's way shorter than the commodity tails, dollar and GOV. So short tails mean not a lot's going on, low momentum, low power, and to the right means uptrend, and to the left means downtrend. So ITOT is in a relative uptrend versus the benchmark. At the moment, not with a lot of power. Actually, it's losing a little bit of power, but that's not going very fast. So we're going to stick with our preference for stocks for the time being. Now look at the weekly tails for the commodity indexes. They basically confirm what you already saw on the daily, or better, the daily is confirming what we're seeing on the weekly. So that's an asset class that is more and more coming to fruition, and something that you might want to consider adding to your portfolio. Real estate doing nicely, coming close to crossing over into leading, as we discussed in our discussion on seasonality last week. The seasonality for real estate for the month of March is pretty good. So this was my surprise for the month of March, a possible surprise for the month of March. And so far it is doing that correctly. We quickly pick out a few of the weekly charts. You can see here that the trend in ITOT is still nicely moving higher. Here is the relative strength versus the benchmark. That's still all nicely moving higher, and the RS ratio remains at a very high level. So you always got to be alert, but if I look at the trend here, you see that all these lows are still nicely at higher levels. So that gives me enough confidence to stick with stocks over bonds for the time being. Especially when you look at GOVT, then you see that is rapidly decelerating. It actually dropped below its previous high. Got this nice double top that executed and is working its way lower. So that works out pretty nicely, I should say. And then you see that the relative strength versus VBINX is continuing lower, and you see a little hiccup here. But if you just look at the trend here, that is definitely down. And the fact that both RRG lines are below 100 is basically picking up that downtrend, and you see a little bit of uptick in momentum, or a slowdown of momentum, I should say. That's holding it back, and that's causing the little hiccup here. But if you just rank it on RS ratio from right to left, then I think we have to say that commodities are now the strongest, followed by stocks. These are the only ones on the right hand side. Real estate is on the edge, and the others are all on a relative downtrend with a little hiccup in momentum. So the big picture, I think, is still intact there. Let's move to the stock market and the sectors. I've loaded up the daily chart of SPY on the right to give us a little bit of perspective on what we're actually looking at when we look 1 week back. And the market is currently open when I'm recording it. So this is Monday, the 1st of March. So 1, 2, 3, 4, 5. So this is Monday, started with a weekday. We dipped and returned to sort of unchanged on Tuesday, had a good day on Wednesday, and then we had those 2 weekdays on Thursday and Friday with rapid and relatively big declines. I mean, I read a tweet of someone, must have been someone of, I don't know, 20 years old, just in the markets for maybe 3 months, who said the market is melting on, I think it was Thursday. And I looked and the market was down, I don't know, 1-2%. Pretty much nothing if you put it into, not even in this perspective, but in the longer term. So I was like, all right, if 1 or 2% down is now the market melting, then what happens when we go down 20% in a period of, I don't know, a couple of weeks? Not saying that it's going to happen anytime soon, but I'm pretty sure that it will happen at some stage again. We just don't know when. That's why we look at those charts. So especially at the end of the week, some weakness, and we actually closed below my trend channel here, and now in the opening we jump back into that channel. I'm not very happy with this break. It's just like the break here. It's, in a way, it's still signaling a little bit of weakness, and if you just look at it from a very, very pure form, we are now on the daily chart making lower lows and lower highs. So that's a little bit difficult to gauge right now with this uptrend going on. So you got to keep that in the back of your mind. So how am I reading this? If this week we can take out this 392.2, then I'm going to say that this is a higher low in this rhythm here. If we cannot take out 392.2, but we will drop below last week's low, that's 378.2, and continue, and then we will have a new series, or that series of lower highs and lower lows will then continue lower. And then I'm sort of on the edge of saying, okay, we're now going into a little bit more of a decline. Still, everything within the longer term uptrends that we will see later when we talk about the monthly charts. So that's for the stock market. Looking at the RRG here and ranking it on performance over those 5 days, then we see a stellar performance for the energy sector. That's improving and improving. And we see very good tails for financials, industrials, and materials. And industrials is the third in terms of performance. Materials was down 2%, but it's outperforming the benchmark. SPY was down 2.5%. So where are our losers, and where is this market, or where did this market lose it last week? And that was technology and consumer discretionary. And those were two of the three sectors that I thought were going to lead higher into the leading quadrant. Their longer term trends are still pretty good, but last week is putting a nasty dent, at least into the short term picture. So we got discretionary moving into lagging, picking up now, but we are in lagging and we're pretty low on the RS ratio scale. And technology is moving into the lagging quadrant. So that's one that it isn't as good as we are used to. So let me put it like that. So we're going to look at the weekly chart in a minute. And then the only one that's actually doing pretty well on the weekly is communication services. It's rolling into the weakening quadrant on the daily, but we'll see that it's actually pretty good on the weekly. So that's your picture for the week, with a good picture and a good performance for energy, financials, industrials, and communication services, I would say. And if we move to the weekly version, then you can see that performance of financials and energy is actually coming nicely together with the tails on the weekly that are bending back to the right. They lost a little bit of momentum. They're still inside the leading quadrant and are now continuing to move to the right. So energy and financials leading sectors at the moment. If we look at technology, then you can see that it's actually jumping back, and that's not what I would like to see. So that's not a good sign for technology, and it's also on the daily losing some strength. So be careful with that one. Communication services actually following through. So that is a nice move there for communication services, still close to the benchmark. What I'm going to pay attention to is that tail lengthening. So we want to see the distances from week to week lengthening and picking up and showing strong momentum. On the weak side, we have staples, utilities, and industrials moving there. So it's a pretty good week on the daily for industrials, but on the weekly, not too much. So here is communication services, and that is actually confirming that weekly tail where it's moving further into the leading quadrant, breaking out of that range. So nice rotation for communication services. So look at technology. We have this range here still intact, and the sector just doesn't seem to be able to actually get out of that range, and that's starting to get slightly worrisome, because this is now for a few months already. We saw that loss, we picked up a little bit, but now we're rolling over again, and that's causing the weekly tail to actually hook back. This is the little hook that you see. Let me zoom that in so we can actually see that a little bit better. You can see, so this is last week and this is today. We're actually accelerating further, but this is only Monday, so I prefer to look at the end of the week, and you can see that it's rotating sharply back. So that's slightly worrisome. And we got the discretionary, where you see that moved to the left. So this is the previous week, this is last week, and we're now getting the follow through on Monday. So this is actually it looks to be ending its rotation back up and moving to the left, and that is also something that is slightly worrisome, and I'd like to see that change in the near future for discretionary to actually again pick up that leading role. But when you look at the relative strength here and you look at the relative line, that seems to be completing a double top pattern, so that's sort of trend ending. So I'm a little bit worried about the characteristics for XLY and XLK. So far, they don't seem to hurt the long-term uptrend for the stock market, but these two sectors, they deserve a little bit more of our attention going forward. And right now, let's go into a quick break of 30 seconds. After that, we'll look at monthly charts and small cap sectors. And we're back. Time to look at monthly charts completed for February. The first one we're going to talk about is the S&P, a SPY. And as you can see, this chart doesn't need a lot of comment and not a lot of annotations. We're still working our way higher. And if we isolate this bar of February, you can see that there was a higher high and a higher low, and we even had a higher close. So both a higher high and a high close. So a new all-time high and a new all-time high close for the month. That's a bullish chart. There's no doubt about it. This is only for Monday, still looking good, but this long-term chart is still all fine. Despite, we had a couple of sort of warning signals on the daily chart before the break, but the long-term picture, as you can see here, is still bullish. There's no doubt about it. If we go to government bonds, we see a different picture. We already saw that weekly chart. We saw that rollover, double top completed. Bond market now testing the highs of early 2016. Sort of support area here. So let's say 26, 26.40. 50. This area here now is support that could cause a little bit of a bounce for bonds and a drop in yields. But the bigger picture is for bonds to decline and yields to go up. So that ratio, that relationship is definitely still there. Another asset class that is interesting to look at right now is following government bonds is corporate bonds. And you see that corporate bonds, LQD, seems to be following the pattern that we already have seen in GOVT, which started to accelerate. You see now here that corporate bonds completed this double top here. And I'd say that the first real support area for LQD is just below 125 US dollars. So keep an eye on the corporate bond market for more declines to come there. Underperformance versus VBINQ, that is. Now the positive news for asset classes, and we've already seen that with the longer term rotations, comes from commodities. And here is the DJP, that's the Bloomberg Commodity Index. You see that we're now definitely clearing this 4 or 5 year trend line, and we're working our way higher to the area around 25. Now I do expect some sort of a setback because we've seen a super rally here and this is sort of begging for a decline. I do think that this overhead resistance level here is probably too heavy to take out immediately, but it does mean that the declines should now be seen as buying opportunities, whereas for a very long time all the rallies should have been seen as selling opportunities. That pattern is now reversing. It looks as if we're reversing a very long-term downtrend into what could be the very beginning of a very long uptrend. But I do think that with this taking out of long-term resistance, we're now in a situation where declines are buying opportunities in the commodity market. Similar picture you see for GSG. Not as far yet as DJP, but you see that we're coming back above a very important support level that was broken, and we're now up there. And I think there's absolutely room for GSG to move higher to the around 17.5, 18 level. And that was it for commodities. Moving on to the sectors. I won't go over all the charts, but I want to pick out a few of the most important sectors, starting with technology. We saw the weakness in terms of relative strength. We saw the weakness in that range on the relative strength line and the RRG lines rolling over. But when we look at this monthly charts, we have to conclude that in February, technology made a new high and a higher low. So a higher high and a higher low from month to month. As a matter of fact, it closed, let's have a look here. So the close for Feb was 130.69, and for January was, this is December. So December was 130.02. 130.02, 128. So actually it's a new closing high. So a new high and a new closing high for tech. That's a bullish thing. We're still above its previous monthly high, that peak that we saw in September. So all in all, the long-term trend for technology is still bullish. We do have some signs of weakness showing up on relative strength and on the weekly chart, but within the longer term time frame, things are still looking pretty good. If we go to discretionary, we have somewhat of a similar picture. Remember, we talked about the RRG moving to the left, so that tail moved to the left. Some sort of weakness on the weekly chart. That's definitely coming from that sort of reversal bar, if you want, here on the month of February. But again, a new high, so a higher high and a higher low. We did have a lower close than we had in January, but you know, all in all, the picture here is pretty bullish. So that weakness, that short-term weakness that we see on the weekly and in terms of relative strength, should be put into this longer-term perspective of a strong uptrend on the monthly charts. Remember, these monthly charts are analyzed based on their absolute trends. It's not relative strength. So trying to put all of that together, all these pieces of the puzzle together, so that weakness in technology, or seeming weakness in technology, seeming weakness in discretionary, it's got to be put into perspective. They both are still in long-term uptrends looking at the monthly charts. If we go to communication services, then we see the same thing. Very nice, higher high, higher low. Strong close, highest close ever for communication services. Once again, a bullish chart. Now, those were the three sort of leading sectors that I had in my head for quite a while already. If we look to the ones that are on the RRG way to the right, that's energy. And you can see here that strength that we're currently experiencing on the RRG and on the weekly and the daily charts. If you look at the monthly, we're running into resistance. So we're running into overhead resistance coming off the low of 2010 and 2016. And that could be a heavy one. It's an important one, because if you look at the level of the highs here, they're continuously lower, and if you want to call this a high, I think it is, then we are completing a bottom formation. But it's very early stage. It's very early stage. So energy, definitely worth our attention. Starting to look at it from a buyer's perspective, where it has been a market for sellers for, I don't know, 5-6 years, you tell me. So this was not a very good market for a long time, and it's now getting a better, more pronounced, longer-term bullish picture. And then I think what's probably the strongest sector at the moment is financials. We're breaking to new all-time highs, new high, new closing high, so that's all bullish for financials, and it is on a nice rotation on the RRG. So all in all, a very strong outlook for financials. And that wraps up my overview for monthly charts. And now for something new, or at least new to me. Maybe you guys had already found it out and you're asking yourselves, what is he talking about? I don't know all the ETFs that are around in the world. And I was with Tom Bowley in his show at Earnings Beats Friday a week ago. And we talked about RRGs, of course, and the large caps and sizes, and even about cryptos. And when Tom started, he showed an RRG of small cap sectors. And I was intrigued because I didn't know that there was such a family of ETFs. I call them families of ETFs. And even during the show, while he was talking, I was thinking about what can we do with this? What can this give us a different angle? Can this give us more information? And here's the article that I wrote about it in last week's Chart Watchers newsletter. But I want to dive into it a little bit deeper today. And we can only touch the surface right now in the time that's left for this show. But I'm definitely going to come back to this in the future. So here's the chart of large cap, small cap, and mid cap. And you see the rotation around the Dow Jones US index. So the first thing that we need to establish, the first observation, is that small caps are strongly outperforming large caps over the last quite some time. So you can see here the rankings. So small caps 9% and large cap 4%. So it's almost double in the last 5 weeks, even despite the falling tail. Now when you look at small caps, which is the RRG here on the right, with the proper benchmark, and in this case we're having small cap sectors with a small cap benchmark, so that's SLY, that's the equivalent of SPY for small caps. You can see a normal RRG, and you can see the tails, and you can see the rotation and everything. Now what interests me is if I can see any differences. So what you can do here is you can actually put them side by side and compare the tails on both RRGs and see if you spot any differences. Now obviously when they move in tandem, there is not much to say, but when these tails are diverging, that's when you get a signal. That's where small caps are on a different path than large caps. So these two look pretty much the same, and you can look at, for example, here is technology on the large caps, and we can find technology here on the small caps, and you see that's a different trajectory, that's a different move. Same for consumer discretionary, and consumer discretionary here is even more pronounced because this is actually pretty strong move, and this is actually a pretty weak move as we discussed it. So you can get some different things. So basically this message here is telling me that consumer discretionary is still a very interesting sector, but the small caps, and not Amazon and Tesla, because that's driving that XLY ETF. So just by putting these side by side, I can already get a different angle and new ideas that I can use in my analysis of the markets. I can't go into all the details. We'll do that because this is a whole new ball game, at least for me, so I'll continue to look at this. If you ever doubted whether small caps were outperforming, do it for yourself, load up this chart, play around with the benchmark, and for example put in SPY, and now you see why small caps are outperforming. All these sectors, all these small cap sectors are outperforming SPY, and that also could give you an angle, guidance, etc., whatever you like to call it. I'm going to work more on this, and I'll actually post a link to this small cap RRG in the comments below so you can copy it to your own system and you can load it up. We're running out of time. This was it for this week, this complete sector spotlight. I hope you enjoyed the show. If you did, please give us a like below, and as usual, put any of your ideas and thoughts in the comments. I hope to see you back next week at Sector Spotlight. It airs every Tuesday from 10:30 to 11 a.m. Eastern. Stay safe and see you back next week.